Okay, guys, today we're going to be talking about taxes, and we're going to make this fun. I know taxes are usually boring, but on Tuesday morning, which is when I'm recording this, the idea is once we can get taxes and understand it fundamentally and get it out of the way, and we won't have to worry about this again, but you will be wiser. So without further ado, let's get into taxes. So in the US, we have four types of taxes. We have federal taxes, FICA, state taxes, and local taxes. Now, there isn't always the last two, but the first two, everybody pays. So, federal taxes, these are paid in every state to the US government. Then we go down FICA. This is a contribution to Social Security. Everybody that works has to contribute to Social Security. The average Social Security benefit in 2023, guess how much it is? It's $1,781.63 as of December 2023. Now, you may be thinking, that's not that much to retire on. And you are right. This is why we need to talk about retirement, and this is why we just talked about budgeting. We're going to get further into that in the coming days, but I need you to understand that taxes are important, and you need to understand them. Now, some states don't have income taxes in them. So some states do. For example, New York, New Jersey, California has a really high income tax, but some states don't. For example, I'll list you a few. Florida, Alaska, Texas, Tennessee, Wyoming, South Dakota, they don't have state taxes. So then if you live there, your taxes are going to be lower. You're probably only paying federal taxes and FICA taxes. That's really good. But then we have local taxes, and some towns even require more taxes. That may be for a variety of reasons. Maybe they use it to improve the roads, maybe they use it for security, doesn't matter. But some states and some towns will have you pay more taxes. So how do taxes work in the US? So the first thing that we need to realize is that taxes in the US are progressive. Federal taxes are progressive. So then what does that mean? It means the more money you earn, the more active income you earn, the more you're going to pay in taxes. That's how it works in most countries, but most people don't understand this, which is why we're going to break it down and make it super simple. So look at this table on the screen. As you can see, as of 2023, these are the tax rates. So up to $10,275, your tax rate is 10%. Now, once you go up, everything that you make in between $10,275 up to $41,775 will be taxed at 12%. So it doesn't mean that everything is being taxed at 12%. It means that everything between $10,000 and $41,000 thereabout is taxed at 12%. And then it goes up 22, 24, 32. And the highest tax bracket is 37%. So then it doesn't mean, once again, that you are taxed if you're earning, let's say, $110,000 every year. It doesn't mean that you are paying 24% on everything that you earn. It means that everything above $89,075 is being taxed at 24%. Then you go lower, everything below $89,075 is being taxed at 22%, up until $41,000, etc., etc., etc. I hope that makes sense. Let's move on, because there are two more things that we need to talk about. There is actually standard deductions. Now, some people get a bit more fancy and do itemized deductions, but these are the standard deductions for everyone from the federal government. What does this mean? This means that for single, married, or head of household, it means that everyone has this tax break already given to them from the federal government. So you don't need to pay for up to around $13,000 on taxes if you are single. So then if you're earning less than $13,000 and you're single, you don't pay any taxes. That's how this works. And then you don't pay taxes on that. Once you go up and up and up, then you don't pay taxes on up to $13,000. Most people, this is fine. So then let's run through an example. Now, I use this example from a town I'm very familiar with, South Orange in New Jersey. This is what someone would pay if they had a salary of an average of $60,000 per year, which is about $5,000 per month, which is exactly the budget that we used earlier. So I want you to check this out. So we have a federal tax marginal rate of 22%. Remember, they're not being taxed on everything at 22%. It's marginal, which means that they're being taxed on a certain percentage at 22%. So then essentially, their entire tax rate is actually just 9%. So then their federal taxes works out to $5,461. Their FICA taxes, you can see there, works out to $4,590. State taxes, New Jersey does have state taxes. So then their state taxes are $2,812. And then your local taxes, there's no local taxes in South Orange, so there's no taxes there. So then what is your total income taxes for the 2023 year? And that works out to $12,863 right there. And your effective tax rate would be 21%. That's what you end up paying, but not from federal taxes, it's from your total taxes there. So then here's the kicker. If you are earning $60,000, your take-home pay is actually only $47,137. And it actually might be a little less than this because your employer may take out some just because they want to be on the safe side for reporting. So it may be more like $45,000. Now, earlier, we had a budget of $5,000 per month. If we are taking out effectively a little over $1,000 every month, then our budget, even though we are reported to be earning $5,000 per month, it's actually a little bit less than $4,000 per month. Now you can see, if we were to revisit our budget, this might become a problem. Why? Because perhaps we budgeted the entire $5,000, but now we actually need to work with maybe $3,900, which is a pretty big difference. This is why it's so important to budget and understand taxes. Okay guys, so that was our lesson on taxes. Understanding that taxes are progressive is very important, and including it into your budget also super important. The next thing that we're going to be talking about is credit and loans and why we need to get this right. I'll see you in the next video.